Absolutely cool, man. Well, we're here. This is totally your foray. This is your thing. I'm a little numerically challenged, so I love all the Web3 aspects of banking. Of course, that's like one of the first things one of the biggest potentials people see in this, which both the Web2 banking guys know and the Web3 enthusiasts, and you can see that in the moves that are being made day in and day out. But definitely you came with us to me with a couple cool things to check out, so I wanted to jump right in, and the number one first thing on the bill is borrow and lending.
Easy.
So tell us a little bit about some of the stuff you've got on your radar as far as that goes.
Yeah, yeah. So borrowing and lending is big in Web3. From those that know, I do still feel like it's been a thing for a long time. I know you came from the Hive blockchain as well, and it was a thing on Hive. It was like that was my first foray into all this Web3 stuff with this. And I know I didn't put Hive on the list. I just figure it's like it's truly old school now at this point. It's like
Yeah,
super.
yeah.
If you know Hive, it's like you're not just OG. You're triple OG if you did the borrowing and lending on Hive, and that's how Money Match
Yeah.
Gaming originally got like our start with DeFi was doing borrowing and lending on that platform. But it's been enhanced in this new Web3 ecosystem, I'd say, and I feel like not everybody's quite caught on to it yet. Even in crypto, in the crypto sphere, because most people stop at Coinbase kind of or whatever. They figure that they bought some crypto and that's as far as you need to go. They don't have a cold wallet or anything. And then even past that, for DeFi degens and stuff, people that are more degenerate with their investments, and in this case, we just say degenerate because you're so early to the party and doing something
Yeah,
that everybody doesn't necessarily know, understand, or know about, or care to take that
and you
risk
hear a
with.
lot of FUD around it, right?
Yeah, yeah. I mean, there can be a lot of fun. You're out there.
From outsiders.
That's the wild west of crypto. Like you're out on the frontier of crypto. Then if you're experimenting with some of these protocols, because some of them are very experimental. But not a lot of people have even heard about it or understood this area. And the main thing is that these are sectors of cryptocurrencies. Or of tokens, if you don't want to call them cryptos, assets, whatever have you, where you can do borrowing and lending the same way that you would do in a bank. And that's the whole, the whole purpose of DeFi, decentralized finance, is to not necessarily to replace, but to give other options for the traditional financial system. Where at a bank, I think the average is somewhere around 0.18 or 0.2% per year or something like that,
Yeah,
interest or whatever you get. And in most cryptocurrency platforms, decentralized finance ones, you're going to find at least 1% on stable coins. And so that's like a stable coin is United States dollars basically backed coin. So USDC, USDT, BUSD, Binance. um, I will leave it for later because I had UST on the list, but that's not necessarily it's a funny thing with UST, and we won't get into it too much right now unless you want to. But that's not the same type of stable coin that most people are referring to when you refer to stable coins. UST is actually an algorithmic stable coin. It's not a backed by actual collateral of United States dollars stable coin like the other ones are.
yeah. We'll definitely get into that more on the stablecoin thing. Yeah, because with lending, it's interesting because I mean, it wouldn't. Would you say that's one of the safer ways to? I mean, obviously, when getting into crypto, lots of people, like you said, they're on Coinbase. Maybe they're even trying to make a quick turnaround profit, right? And they're not in it for
Mm-hmm.
the long haul, and so that can lend to a little more risky of you're risking your money a little bit more. Whereas, and maybe that's the most common way to like first get into crypto, whereas I like learned things like you said on the Hive blockchain back in the day that I didn't even know that's what I was doing, right? I just had it, I was just playing Splinterlands. I didn't know it was a GameFi game. I didn't know it was NFT game, right? And you're just staking the coins and making getting a bigger
Get that big
following
return,
on.
that
Yeah,
interest.
exactly, the rate of returns and getting that interest, and you didn't even. I'm not even really thinking about it. I'm like, well, obviously I'm putting back into this this platform that I'm growing on, so it just makes sense. And you're like, oh, I'm actually learning. So
Right.
but but as far as like the lending goes, would you say that's one of the safer ways to actually put your money at work in Web3?
Yeah, I think so. Because of it's a simpler way of doing things where you can do it single assets. So instead of needing to know about liquidity, and providing how to, I have AMMs on the list too, but like instead of knowing how to make liquidity pairs, okay, pair up two tokens of half and half and put them on an exchange for people to use basically, and all this other crazy stuff. All you have to do is have that solo asset. So you can have Bitcoin, you can have Ethereum, you could have like I said before, USDC or USDT, Tether, any of these different individual assets, and you can put them somewhere, stake them somewhere, as you're referring to, and then start earning interest on those. And so it's that much easier with that, with most of these borrowing and lending platforms where it's a solo asset and you can do that. Yeah, and again, like I mentioned, Hive briefly, but like, yeah, that's how Money Match Gaming got our start, which was, you're talking about, you can stake on Hive, and for people that don't know, it's a social media platform where you upvote or like somebody's post, and it gives them a percentage of crypto, or a certain amount of cryptocurrency, in however much Hive power you have in your account, or how many Hive you have in your account, determines how much you can drop on somebody's post. And so, in the same way that these platforms, and it's all going to connect, but with these platforms, borrowing and lending, so we have Compound on the list, have Venus.io on the list, Aave is a big one on the list. But with these platforms, you can not only invest your cryptocurrency, so stake your cryptocurrency on that platform, and then take out a loan. So it's a way you can lend, and then you can also borrow the same time. You don't have to just lend and actually they give you something most times. So you lend, and then you can also take out a loan, or you can just lend and make interest on your thing. But a lot of people like to, it's a way of without there being trading markets or whatever, or leverage trading markets, there's a way for you to basically short the market in that sense, because you can lend your Ethereum at a time when the Ethereum market is maybe dipping. And so your Ethereum sitting there, it's earning interest for you since you lended it, and then you take out a loan in United States or USDC or USDT, and you wait for the market to dip down that much lower, and then like any loan or whatever, you have to pay it back slowly, at some amount. In this case, you don't have to pay it back at a specific amount of or time, but you have to pay it back before the price dips too much or something. So you can add back into your position to keep from getting liquidated. Which means you lost the game basically, and so as the market goes down and you have this pile of USDC that you took out as a loan, you can just buy back in at Ethereum at a lower price. And so that's what a lot of people are doing, in decentralized finance versus traditional finance. And again, I said I was going to work this all back, and this is what Money Match Gaming did at the beginning on Hive, which was that I explained how you increase your post, the amount that can be put on a post. So we would go and we would borrow Hive power. We would go, lend and borrow Hive power, and so we get that much more Hive power that we have for a specific amount of time. But then we had to pay that back, and so we would like up people's posts, or within our ecosystem that we knew we could get some profit from. And then eventually we made a bot, since that was the big thing at the time, to make a bot that took in orders. Basically, and it's like having a shop that has auto money coming in for you, but it took in orders for people that wanted their posts to be liked, and that was a way for us to make sure that, and that's the same way the banking system works, and that's why I'm bringing it up, because then you created a product that yes, you took out a loan for something, because the bank's going to give you a loan, if you're like a business entrepreneur or whatever, and you're like, okay, I have this investment that I want to make, and they're going to give you that loan if they believe that that investment's going to be profitable for you, so that you can pay back the bank.
Right.
And so in Hive, if you make one of these bots, then people would pay you money. So you have constant flow of money coming in, and then you could pay back your loan for the Hive power, with the added money that you got. So you probably got a little bit extra on top of that. So that's kind of how it works on blockchain and financial system, and I know that's a lot to cover, so it's like a lot of information,
great.
Folks.
Those creation systems on Hive, again, that was an early an early adopter of that, without even knowing how huge that would be in the future. And yeah, Hive's a really crazy thing in Web3. So early in the game on so many things that they're actually doing well, right? They even have like NFT showcase, right? Was that what it's called? I believe.
Yeah.
So yeah. Definitely, everyone check that out. I've got that
showroom,
up right now.
NFT showroom.
Showroom, thank you. Yes. Showcase. I know it's close enough that I threw you off. And even some new ones on there that I'm looking at too. So yeah, everyone go and check that out. Yeah. So all right, P2p trading is what we got next, and this one I'm actually not familiar with at all. So yeah, tell us a little bit about P2p trading.
Yeah, so I know I titled the P2p trading on the list.
P2P, rather.
Yeah, so peer-to-peer trading on the list, and this is to instead of it's called, I call it peer-to-peer trading on the list, but it's truly like peer to contract to smart contract to peer trading.
Technically, yeah.
Okay. But initially on the blockchain, and a lot of people, this is a lot of people's perception of what you can do in cryptocurrency, other than the major exchanges, Binance or Coinbase. Most people assume that, if there's a bunch of Bitcoin being traded or something like that, it's going, you find somebody, and this is how you used to do it. You find somebody, and you go, okay, yeah, you send me Bitcoin, I send you this, but you barter with the person basically. You make up a deal, and what's it called when it's not over the counter? I forget. Maybe just peer to peer. It's not like a shop. But you basically make the deal with that person, and it's a very peer to peer. Like I'm talking to you, communicating with you directly to make this trade. But now in cryptocurrency, there are smart contracts, and we use what's known as AMM protocol, so automated market maker protocols. Right. And those are, you might have heard some of these names from very popular automated market makers like Uniswap, like Curve Finance, and I know that's a little less, you probably want to be in cryptocurrency for that one, or a silly name for one is PancakeSwap, like as if Uniswap isn't, but PancakeSwap definitely throws people for a loop. Justin Sun on the Tron blockchain created Sun.io, SunSwap, but these are examples of automated market makers. Yep. So you popping that up. Actually, let me make sure. I don't know. Like that. I don't know what that one is. There it is. The other one. Don't connect to that site.
Yeah. Sure.
But if you click the trade column there at the top, and that'll take you to the DEX portion of this thing. And so this is how people are doing trading. And so automated market maker allows you to basically in banking or in normal trading, the exchange is making the money or the bank is making the money because you're facilitating your actions between them, and there's somebody that works there. They have to pay, there's a middleman, and so in this case, the smart contract is there, and there is no middleman. It's like it's directly you to the other person, and there's an application that is decentralized, and so it's not going to take the money, and so there's fees that come out, and those fees go to people that supply liquidity, and so liquidity is a bunch of money. You need a bunch of money or liquidity to be able to do things, and so people
you need money to move money.
Yeah, exactly. Yeah, you need money on either side of a trade to do something. Somebody has to have that object, and that's liquidity. And if you have a bunch of money, then you're really liquid. That's what they say.
Right.
But for AMMs, you need to supply half and half, and so if you wanted to help with or do like Bitcoin trading or something like that, at some point somebody has to put Bitcoin and let's say you're going from between Bitcoin and USDT, so Tether. So at some point somebody has to put up Bitcoin and Tether as a liquidity pair on one of these automated market makers, which are also that's the protocol behind the scenes. They're also known as DEXs, so decentralized exchanges. But somebody has to put up 50-50 of each. So you put up 50% of Bitcoin and then 50% of, and that's the section you go into. And if you push add liquidity at the bottom there, this is where you do it. So at the top, you can put Bitcoin. Right there. BTCB. Or BNB is fine. But yeah, BTCB, it's like a fifth or so on the list right there.
We'll go from that to that. There we go.
Yeah, so BTCB, and you can also type it in when you're with these two. And then USDT would be like the bottom one, and then you'd need equal portions of each. And so, imagining you in this case, let's say you had that, so it'll tell you like the number. It should like load it up in the bottom after you but if you had 0.1 Bitcoin, it'll tell you how much that is in USDT, and so you need equal halves of both of those. You basically push them together, so and that's how it's like an analogy. You pair them together, think of it as a sandwich, and then that's your liquidity pair. So liquidity pair, because it's equal. And now that you've made that pair of Bitcoin and USDT, people can trade between Bitcoin and USDT. However, since you maybe only have like $1,000 or so that you did that with, that kind of sets like the rate of how much can be exchanged. So if there's only $1,000 of liquidity in Bitcoin and USDT, then if somebody were to, I want $1,000 worth of Bitcoin, it's going to cost them that much more for it. It's going to the price is going to be that like higher because there's only so much of it on the market. But as more and more Bitcoin and USDT gets on the market, it'll be more common price, like what the actual price is, more market price, let's just say, what the actual price is. So that's kind of how that balances out. But yeah, this is the practice people use in cases that, and this is just like an example of like one of these pairs. Like, let's say you want to go from Bitcoin to, BNB or ETH, but there was a whole bunch of Bitcoin and USDT on the exchange. They basically do what's called routing. And so they take that Bitcoin and they would find the best deal basically for it on the automated market maker. So they go, okay, the best deal is actually Bitcoin to BNB. And then we'll take that BNB and we'll do BNB to USDT. And we'll send you the USDT. So you sent us Bitcoin, but the best deal over here was Bitcoin to BNB. And so we took the Bitcoin, then we went Bitcoin to BNB, and then we went BNB to USDT, and then we sent you the USDT. So they'll find the best route for you. Yeah, and all along the way, if you put liquidity in there, people that pair the liquidity together are earning fees. So you're actually earning fees on what liquidity you put there. So it'll tell you what percentage of the entire liquidity pool that you own when you make a liquidity pair. And and depending on that pair, like you can also, like, sometimes they have the numbers like 0.03% or something like that of every trade that you earn a percentage of. And so if you have a larger percentage, if you have 1% of the pool, then you're earning pretty much 1% of 0.03 of every single trade that happens. And there's a ton of trades that happen on these things, so it can be lucrative. And this is also how you get things like farms that come out of these things, because then the farm has an incentive to make more and more people put all of their liquidity pairs on the farm for a third-party token, and then the farm is earning the fees and they can do something with it.
Absolutely, yeah. And yield farming is a huge, but I don't know if we have that specifically, but like, that'll be next. Let's just dive right into that. So dividends and yields, perfect segue there. Tell us a little bit about that. What are some good sites to go to check out these things as we're talking about them?
Yeah. So dividend and yields is kind of what I just started to allude to, which is that, when after you make a liquidity pair, you can just leave it on the automated market maker, like where you created it. You can just stop right there. You made the pair and you don't have to go any farther. Now people can trade between your tokens and you'll start earning fees, but it's going to, unless you put like a ton of money down at this point, it's going to take a while for you to actually be earning something. And there's a thing called impermanent loss. And so, we'll get to that maybe later. That's like a whole thing. But you start earning money right away.
In a bear market, that's pretty. I mean, would this be weird? We were talking about impermanent loss. Would this be a good? I mean, because in a bear market, it's actually pretty.
It's the right way to go, kind of.
Well, right. Especially when people 3-4 months ago, people were asking me if they should buy, and the reason I didn't is because, I mean, if you're getting into it during a bull market at any point, or however you're getting into it, whether it's like directly by just buying tokens or looking to yield farm or whatever, I mean, it's going to be a little more risky, right, at the top of a market, or how does that work? Right?
Yeah. It's like not necessarily that it's like more risky with the yield, or I mean, risky at any point in time, right? You have to have your own risk tolerance. But like, I feel like what you're referring to is like, missing out on earnings, on gains, right? So in a bull market, when the market's going up on an individual asset, when you pair the two tokens together as liquidity for a liquidity pair, then you're missing out on some of the upside gain of the token because it's trying to balance out the entire time. So it's playing a teeter-tottering game. And so since it's playing this teeter-tottering game, like let's say you put a bunch, Bitcoin and USDT, we're going to stay with that one, together. Well, USDT is obviously pegged at $1 and Bitcoin is not. So as Bitcoin continues to climb, they're going to balance that out and they're going to give you, some USDT, as people do trades and stuff like that, they're going to give you USDT, which is not going up at the rate of Bitcoin. And so Bitcoin goes up 200%. You don't get a 200% gain with your liquidity pair. You might get like a 50% at that point or something like that, somewhere around there. And I'm just throwing out, but it's like it's not going to be 200%. You're going to get some gain, but it's not going to be 200% gain. Your main gain from the liquidity pair comes from, and that's why yield farming is so big with liquidity pairs, because you can earn that much more than you would in fees with a liquidity farm. So with farming, or which is like similar to like dividends and stocks. So the way to think of a farm is like almost honestly to think of it like as a business in a sense. I think because they're decentralized applications, and I think any decentralized application you kind of want to think of as like a business, in my opinion. That's a better way of like trying to understand it. Like, okay, this is this business or storefront, and how successful is this business or storefront, and if it's a really successful one, like Apple or something, then maybe you can get some dividends from it.
Right.
And if it's not successful, then it's probably not going to be paying out any dividends. And then eventually, what happens to that store? But that's kind of that way of things going.
Gotcha.
Yeah. Yeah. Oh, but right. Yeah. In a bull market, yeah. Again, just to wrap up, bull market, you probably want to be solo asset, because then if Bitcoin climbed 200%, you get the 200% gain. But if you had it paired together, you're gonna get like 50%. Bear market, let's say you had that $1,000, $2,000 of Bitcoin and USDT paired together, it's kind of protecting you from the downward fall. Again, since it's not gonna move as drastically because it's paired with something, and so that's also what you seem to have a good eye on that.
Yeah, that's I get basically less fluent in saying it, but yeah, that's definitely what I was trying to get at, is that idea. Let's see, any chats? No, nothing particular. All right, let's go to what else we got here next. Oh well, yeah, let's go into stablecoins a little bit more. Lately, I mean, just from my end of things, from a little bit of the outside in, I don't deal in stablecoins too much unless I'm getting paid in them. But I'm wondering, just like I've heard of them getting off peg recently, and what are the real risks there, and just kind of work that into like, I don't know, and teaching me, man. Well, what's going on there?
Yeah. So a stable coin
is they're stable.
I'll go from a few different approaches with this one. So stablecoin is basically supposed to be pegged to the United States dollar, right? If that's what it's pegged to. So they can be pegged to different things, actually. A stable token can be pegged to whatever. It can be pegged. There's some out there that are pegged to Ethereum or fractions of Ethereum or fractions of Bitcoin, whatever have you, or to other popular tokens in the blockchain, like some are pegged to Phantom or Matic or whatever. So most people know stablecoins though as being pegged to the United States dollar. In saying that, should also mention that the United States dollar is not necessarily stable. So while before we get too deep into things, and I'm not saying it like in a doom and gloom type of way where people are like, oh yeah, the market's going down, it's bad. I'm just saying, like, there's times when the dollar is stronger and there's times when the dollar is weaker. And so since 2021, like honestly, if you look at a DXY chart, so the USD index, the dollar has been getting stronger like every single day since like January 10th, 2021. Like it's been getting like stronger it's on a crazy bull run, the dollar's strength. So the dollar's been getting stronger, and that's because everybody knew that started to learn that we were doing like a whole bunch of money printing and stuff. But what happens when you stop printing money? Like a lot of the reason why people like Bitcoin is because it's more scarce, right? And the reason why people like gold is because it's more scarce. So when you stop printing so much of something, or any item that you like in the store, then it becomes more valuable. And so the same thing started to happen in the United States dollar. Basically, they're not going to print as much as it. They're going to require more fees and stuff on things. Then it becomes more valuable. It strengthens up. And so the same thing can be said for that. And so I wanted to bring that into perspective first, just so that people kind of get an idea of like, when like, oh, stable coins being off peg, whatever, this and that. And I'm like, well, United States dollar gets off peg too. It's not always worth 100 points, which would be like, this is its true value of a United States dollar. At its heyday, it was like 120 points or whatever the heck. 130 points or whatever. I think it's somewhere around there. And over the last few years, we went as low as like 86 points or something like that, which is like, it's like having 84 cents per every United States dollar. It's like its actual value. It's like not good, guys. And that's why we started doing the stimulus package thing, because they were like, all right, we need to stimulate the economy, because and like that's also part of the reason why it got so low, because they threw so much money out there. But we're not going to get too much into the economics. It's more macro discussion. But that's how stablecoins generally work, right? And that's why you can sometimes stablecoins become off peg, and generally another reason why they're off peg is a run on the banks. And so that's like one thing that would destabilize our dollar, the United States dollar, right, which is the global reserve currency. And what's happened in Turkey and what started to happen in Russia with the ruble and stuff like that is a run on the banks. And that's when people go to the bank and they say, and what happened to UST, but it's when people go to that bank, that issuer, and they say, I want those stable coins, or I want whatever the token of value, whatever my thing of value is. And so in the case of global currencies, they want their, I don't want my digital receipt anymore. I want the actual thing, and I want to hold it tangible. Or in the case of UST, I want that, I don't want this altcoin anymore, this meme token or whatever. I want my actual UST. I want that stable coin. And the issue comes along because banks over leverage. So banks take in money, and then they basically loan out more money than they have in the bank. And they charge interest rates on the money that they loan out, so that they have a steady flow of income coming in. But they don't necessarily have all that money there. And so if everybody asks for their money at the same time, or if even like 10% of everybody like asks for the money, then there's what they call a run on the banks. And you have issues with the supply, because then people lose trust in that thing. And like as much as people in traditional finance like to throw around the trust word at Bitcoin and everything else, the same thing exists in traditional finance. Like these blockchain and DeFi and all this stuff didn't come out of nowhere. It came out of trying to solve these problems that exist in traditional finance, and that's why they've been so successful thus far. Because all we're doing, especially at this current point in day and age, is relying on trust of the system. Trust that it won't fail like it has failed in the last 50 years, in the last 100 years, in the last 70, and that's just speaking on USD. And you go to other countries,
history of money of any currency.
You go to other countries, and it's happening like every year. It's like it's constantly happening. And so and it's because there's such a level of trust. And most recently, a lot of trust was lost with USD, just because we printed so much, we hurt other people's economies and stuff like that. And Americans are like, we're having it bad. And it's like other countries are having it way worse, guarantee you. So we lost some of that trust there. But yeah, that's the run of the banks, and all these other factors is kind of how things destabilize. But yeah, stable coins supposed to stay stable, and the way that they generally stay stable, just to kind of wrap things back in there, because I feel like we want a little lesson, kind of.
Well, it's with the over collateralization, right?
Okay. Yep, exactly. So you want to over collateralizing, and that's also back to the borrowing and lending thing. That's how cryptocurrency generally works. For borrowing and lending, it's not just collateralizing the thing, and by that, what that means for people that don't understand is you collateral. You want to supply that asset or that monetary value to pay for the thing or whatever to have you. And so stable coins, if you're saying you have 100 stable coins to issue to people, want to give out 100 USDT to people, then you need to have $100, 100 actual United States dollars to issue to people. And so it's the thing that the banks aren't currently doing. And so because all this regulation's coming down on stable coins, and it's funny because the banks don't even have that much money. The banks they're not as collateralized as the stable coins, and as the cryptocurrency market is in some respects. They just and they have the ability to just print out more. So they'll just fix the issue by themselves just because they have the button to press. But they're coming at other people, and it's not. And I'm not coming at them this and that, because obviously it has its benefits in the world. We want to see the world stay stabilized, right? I'm not a doom and gloomist type of person. But it's funny, so strong, and we need to regulate this sector so strong, and I'm like, we need to do it at home too. Jesus, stop pushing the button all the time. Which is why people turn to these concepts of DeFi, because why not have a smart contract do it with take out all the emotion, take out all the sanctioning power and all this other stuff, no sanctions, no tariffs, no blah, 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 blah. It's a straight up piece of code that's going to do what it needs to do to maintain that peg. This happens, then that. If this, then that's code. That's code in a nutshell. If this, then that. Period.
Absolutely. Yeah, well, that's why Web3, because that encompasses so many things we do as a society, right? That it's so simple. The code can be placed, and it can make things more simple, through the smart contracts and everything like that. So
right. And the last thing that I would say about stable, because I feel like we pretty much covered that's how USDT works. That's how borrowing and lending works. It's if there's $100 of USDT for them to issue, then they probably have at least 120 actual United States dollars. Same thing if you're doing borrowing and lending. If you want to borrow 100 USDT from a borrowing and lending app, you need to supply $120 worth of Bitcoin or Ethereum. or whatever have you, and then you need to pay back that, be paying that back before you get liquidated. And so they create that money funnel from you. And so it is working the same way that we have banking working, but without all the because this happened during the pandemic. So use an example. Oh, but we really like this store. This has been American. Like, this has been an American store. Let's give them a bailout. What about the mom and pop stores? Let them close. Let them close. Let's give these big boys the bailout. And in cryptocurrency, that's not happening. Everybody's on the same footing. You better come up with that money. You better do whatever the heck you have to do, because the code is not going to care. The code is not going to change its reaction and be like, oh, but you've always been so nice to me, and you give me extra getting. They don't care. Code don't care. So that's.
I love that aspect, man. Yeah, nothing. That was. There's still. I have my eyes on. I know which some of those companies, and I'm like, when I want a sandwich, sometimes I'd rather just drive by certain places.
Yeah.
All right, man. Well, yeah, that's just big business for you, huh? And that's another aspect. We'll get into that too. I'm sure that's a whole nother show. Just
yeah, and I mean, it comes down to the same, because the country, or the Federal Reserve, and I'm sure there's some other policymakers and stuff, but having faith that these bigger corporations can continue to produce, and it's them having less faith than in the local community actually going out and supporting those places to a degree, because they're like, oh, well then let's use McDonald's as an example, because we know damn well McDonald's probably got so much money, right? Come on, folks, let's not play. So we're using McDonald's as an example. McDonald's gets a bailout basically during the pandemic and mom and pop store does not get nearly as much as McDonald's gets. This allows them to stay in business, and that's because by history, McDonald's has a line around the building, and how often does mom and pop store do that? Maybe once, twice a month, or something like that, maybe. So they don't have as much faith in them in the same way that the bank works on giving out their loans. If they believe that this other entity can produce and create that interest, that return on interest, then they're going to give that money to them.
Yeah. Well, that's just one of the many reasons to shop local whenever you can. Because especially, you never. I mean, that's true. I'm sure there's a list out there, but when it comes to the big ones, you're like, you can't just kind of assume.
Mm-hmm.
I'm sure Walmart really needed all the money that they got, and all the tax breaks they got. So that's just the way it works. All right, next, here's another one that I don't recognize here. So we got Rebase Tokens.
Yes.
Tell us a little bit about these. What's up with the Rebase Tokens?
Yeah, so you can get like a whole list of different Rebase tokens. They come here and they come there. What is a Rebase token? Let's go to arbitrary. Yeah,
what's a Rebase token?
A Rebase token is basically, I would compare it to, if you've heard of quantitative easing, right? Maybe you've heard of QE before, QE2. A Rebase token is basically quantitative easing on the blockchain, except for with quantitative easing, you have, and that's all quantitative easing really is, on both sides, quantitative easing and quantitative tightening. So both pairs, both sides of it, I would say. So with that, you have the expanding money supply, quantitative easing, and the contracting money supply, which is what we're currently doing, actually, quantitative tightening. And so that's when people say the Fed is either dovish, quantitative easing, or hawkish, quantitative tightening. And so Rebase tokens basically work in that exact same manner with code. And so they inflate the supply, and then they contract the supply. And they do that in a way that the tokens stay in your wallet. And so if you have 100 tokens, let's keep it 100 tokens. You have 100 tokens of Ditto or AMPLE, Ample, Fourth, which are two Rebase tokens. They're supposed to be pegged to 100 or $1, right? And so you have 100 tokens of those. And what happens when, similar to, right now, USD index is above 100 points. So what happens when it starts to go above that? And we kind of saw this with USD index as well. When it starts to go above it, and it goes too far above it, in the case of Ample Fourth, I believe it's something like 5% or something like that. If it goes 5% too far above peg, then it starts to contract. And so, if your 100 tokens started to be worth $1.05, they do something with the supply of the tokens where I believe it's either, and I forget which specific way it is. And some of them work slightly differently, but either they increase the amount of tokens that you have in your wallet, so basically diluting that to make it on pair with 100, per 100, or they shrink it. And that's their, and so they make it so that you have less tokens, and so it's either increasing or shrinking that amount, and it does it like pretty much automatically, to
Okay.
to keep things on peg, and that's a very layman's way of going about it, because like you can understand something without being like, I know all the specific math and percentages of how
Oh no, for
it's
sure.
really hard to
Well, I'm
it's really
just
hard to get a lot of
I
these
was,
concepts. So I'm just trying to share it with you guys.
yeah.
But that is like, always with any things we're talking about, go do your own research, because I do my own research. I've been researching this stuff for years at this point, and I still have to go back and not only just because they're updating, but to try to get a better understanding of it after I've learned some other things in traditional finance or in decentralized finance, and try to wrap my head that much stronger around some of these concepts or the percentages and how they work with the elastic supply and contracting supply, etc. But that's really all it is. It's the supply will either expand or to contract. And so when it's too much, the value is too much, it'll expand the supply. And when the value is too little, it'll start contracting the supply, and bring more value to that token.
Right. Interesting. So essentially, the Rebase tokens and the what's the other one? The Reflect tokens are how stablecoins work, is what you're saying.
With Rebase, yeah, yes, Reflect tokens are slightly different.
Okay, so
they're not even like the like Rebase or stablecoins. So Reflect tokens are like another measure, and those are kind of more like interest bearing tokens or dividend stocks or something.
Okay.
Yeah. So with Reflect tokens, those are tokens that, and I believe the first one was called RFI, which is maybe why I think that's how I got the idea of Reflect, because Reflect is RF is the first one of that. But it basically means like if you hold this token, then you get more of another token. And so in some cases with Reflect tokens, like by holding this one token, you get more of that same token. So you get interest paid out to you in that same token. Or in the case of other tokens, like a very popular one among DeFi degens is a Baby Doge. So if you hold Baby Dogecoin, then you get, which I think you might get both, but you get more Dogecoin. So you hold Baby Dogecoin, and they reflect to you Dogecoin. And the way they do that is by putting, and this is why I'm like, when the government finally understands decentralized finance and stuff like that, I don't understand why taxes aren't just like hooked up in cryptocurrency. But all they do is they put a tax on the token. And so any trade sales, any buys or sells between the token have a tax on them. And so you have to increase your slippage on the DEX or the AMM that we showed earlier. And your slippage just means that when you trade something, you open it up to a wider margin. So think of like arbitrage trading, where you might sell something for $1 in one place, and in another place it might cost $1.05. So you open yourself up to that margin gap, and that's how you get the trade through, because they're going to take that 5 cents. It's the tax. And so with things like Baby Dogecoin, it's like a 10 or 15% tax or something like that. So before you sell the token, you probably want to see it make a 15 or 20% climb. But the reason for you to not sell the token is because as other people do those trades between the token, you end up earning, again, either more of that same token or more of another token. And the other token that you would earn in the case of Baby Dogecoin is actual Dogecoin. So you have Baby Dogecoin, which is going up in value potentially, maybe not, as people trade between it. And then you have Dogecoin, which is doing its own thing, but these tokens are often worked in a way that they automatically will go and buy up that other token. And so not only do they supply that thing, but they'll go and they'll take, the trade was made, and they'll take a percentage of that trade, and they'll put some of it into liquidity. So they'll strengthen the market itself and make it so that more money can be traded between that token. And then they'll take another percentage of that, and they'll buy up Dogecoin or whatever the other coin is. And then they'll send that to all the users of the token. And so, or all the holders of the token. And so anybody who's holding the token gets a percentage of that. And so maybe it's 0.01 Dogecoin, or if you have a whole bunch of the tokens, it could be every few minutes. And this is why SafeMoon was so big. SafeMoon is another Reflect token. And SafeMoon just pays people back in SafeMoon token, per all the trades and stuff like that. But yeah, that's how those work.
Dang, well, that's something I'm definitely gonna have to look more into. Everyone's heard of SafeMoon, but of course SafeMoon's got its
It's got its problems, and like it's SafeMoon's problem. SafeMoon wouldn't have those problems if it wasn't for malicious actors with the project.
Of course,
because that's really where like a lot of it comes from. It comes from malicious actors. Like a lot of the FUD around SafeMoon is from misallocation of funds. You know,
Right.
if the funds weren't misallocated, there'd be no issue. You know, there'd be no issue. It'd just been working the way it's supposed to work, but
I
people
started
get
watching my
greedy.
CoffeeZilla. I'm catching up.
Yeah.
All right, cool, man.
Yeah.
Go ahead. What?
Oh no
You
no
got
no! I was
something
gonna say
on
something about
no?
CoffeeZilla. I was like, yeah, it's an interesting character. It's not a bad person to watch, because they, I feel like they have a harsh critique sometimes of projects, but sometimes you need that. You know, you need that harsher critique.
I appreciate him because, yeah, well, I'm coming from a journalism background. I love the gotcha, hard hitting stuff
Mm-hmm.
that, like, he's not worried about making friends in the industry because he's not necessarily part of the industry. And sometimes those are the best
Yeah,
people to have as, watchdogs in for an industry. So,
yeah.
I've reached out. I was like, let's get him on this show.
See,
So, yeah,
yeah, like you can't just have people that are super sipping the Kool Aid all the time. You need the other, you
yeah,
need the other side of things, and that's the same thing
yep.
for politics or anything else. Like if anybody's like too much in your same, then you need to hear from somebody else at least to get that other side of things.
Yeah, absolutely. Cool, man. All right. Well, as always, Smurf, thank you so much for hanging out. Tell us a little bit about what's going on for Money Match Gaming in next couple days or next week.
Yeah, so we are entering a little bit of a break period for events. We just had the block and chain finish. Castle took it over BR1 AV, aka Bruno, who is the always ranked very high in Ecuador. But that was a really good event, and we are preparing for our summer league, which will be our league
Let's
where we
go.
have blockchain games alongside traditional AAA games. And all of this is a time that we will be ramping up our advertising and whatnot, because we'll have our DAO NFTs coming out soon. And I wanted to use the summer league as a time to let people see like what we do when we actually like our advertising, like our whole thing and stuff like that, as well as what they can expect from these events, and what you get out of the events when you purchase our DAO NFTs. So that's coming down the pipe, and then also experimenting with loop ring, because gotta
What's
jump
that?
on different blockchains when you can. Loop
Okay.
ring, what is loop ring? Loop ring is
Yeah.
another layer 2 token, so it's an ERC20 that has its own blockchain. The creator of loop ring came from Google dev teams. So big name in developing worlds and stuff like that, or the dev world. But LRC Loopring is a layer 2 solution to Ethereum. They currently have a partnership with GameStop, and so GameStop has two cryptocurrency partnerships. One is with Immutable X, who runs Gods Unchained and a bunch of other up and coming blockchain games that not all, some of them are in beta and stuff like that. And they also have Loopring, and so the GameStop or GME GameStop, the marketplace is supposed to be on Loopring, and yeah,
Oh,
and so they
okay.
actually have a GameStop wallet which you can now use to get on Loopring, and I made a GameStop wallet and stuff. So
Nice.
so yeah, that's what Loopring is. It's a cheaper place to do NFTs and everything. What you can do trading and pools. It's another solution, or scaling solution to Ethereum.
Cool. And so you're getting in there and working with that.
Yep. Yeah. Getting in there, trying some things out. I'm gonna be making some NFTs. I think maybe some pre-DAO NFTs, like because
Okay.
our DAO NFTs will most likely come out on the Wax blockchain, and
Right. Got to
yeah.
stay true.
I just say I like the fees, transactions, just everything the Wax
Yeah.
has is pretty dang amazing. I know Solana's been popping off for all the normies and
It's
NFT
true.
traders and stuff. Give them their credit, but I think Loopring has a space right now where you can take advantage of something.
There
So
you go. Nice.
yeah,
Yeah, there's always something new to check out. So yeah, everyone get over, check out Loopring. Make sure you're following Money Match Gaming over on Twitter to follow the Summer League, get in on all that action. And again, thank you everyone for watching Web3 Throwdown. As always, I'm Shawn S. Porter, and we'll see you next time. Later. All right, we're off audio. Well, good job, man. I learned a lot.
yeah, awesome.
That was a lot for me to take in. So
Yeah, it's a lot
hopefully,
of information, man. That's why I was like, at that one point, I'm like, I know I'm not articulating everything perfectly,
no,
but it's just because there's so much, and it's like, to know how everything works so intricately is like, that's crazy. It's like that's why like people like Richard Hart are kind of fascinating
yeah,
to
you
me,
good.
where I'm like, this man is a wealth of knowledge. Like you are very polarizing often, but and, like sometimes just crude, but you're
Yeah,
extremely smart.
I think some of those smart. That's the way. Just the smarter you get, maybe some of those social cues are less front and center in your brain, for
Yeah.
lack of a better, psycho
Mm.
analysis.
True.
Stuff to share there. Here, cool. All right. Well, I don't have anything up for next week. Any ideas or anything like that?
I have. Oh, here, let me stop this. I forgot. I was doing like a recording of myself for you guys. I'll see you guys in a bit, because we're gonna talk about what's coming down the pipeline. It's NFT stuff, gaming stuff. Yeah, I'll see you guys.